Navigating the High Wire Act. Unveiling the risks of investing in high-yield or junk bonds. In the realm of fixed-income securities, high-yield or junk bonds stand as both alluring and treacherous terrain for investors seeking enhanced returns. These bonds, typically issued by companies with lower credit ratings, offer the promise of attractive yields but come with a set of risks that can shake even the most resilient portfolios. Understanding the intricacies of the risks associated with high-yield bonds is paramount for investors looking to balance risk and reward in their investment strategies. Credit risk at the forefront. At the heart of the risks associated with high-yield or junk bonds lies the omnipresent specter of credit risk. These bonds are issued by companies with lower credit ratings, implying a higher likelihood of default compared to investment-grade counterparts. Investors must grapple with the possibility that the issuing company may face financial distress. Making timely interest payments and, ultimately, returning the principal amount a precarious proposition. For instance, consider a high-yield bond issued by a company operating in a cyclical industry. If economic conditions take a downturn, the company's revenue and cash flow may decline, increasing the risk of default on its debt obligations. Investors in such bonds may find themselves facing not only diminished income but also the potential for significant capital losses if the issuing company defaults on its payments. Interest rate sensitivity. While high-yield bonds offer higher yields to compensate for their elevated credit risk, they remain sensitive to fluctuations in interest rates. The inverse relationship between bond prices and interest rates means that when interest rates rise, the prices of existing bonds tend to decline. This interest rate sensitivity can lead to capital losses for investors holding high-yield bonds in a rising rate environment. To illustrate, consider an investor who holds a portfolio of high-yield bonds with fixed interest rates. If market interest rates increase, newly issued bonds with higher coupon rates become more attractive to investors. This shift in preference can result in a decline in the market value of existing bonds with lower coupon rates, affecting the overall value of the high-yield bond portfolio. Liquidity challenges. High-yield bonds often exhibit lower liquidity compared to their investment-grade counterparts. The market for these bonds may be less active, with a limited number of buyers and sellers. This reduced liquidity can pose challenges for investors looking to buy or sell high-yield bonds, particularly during periods of market stress or economic uncertainty. In a scenario where an investor needs to sell high-yield bonds quickly, the lack of liquidity may result in larger than expected price discounts. Conversely, purchasing high-yield bonds in illiquid markets may lead to higher transaction costs. Investors must factor in these liquidity challenges when considering high-yield bonds as part of their investment portfolios. Market and economic volatility. High-yield bonds are often more susceptible to market and economic volatility than their investment-grade counterparts. The companies issuing high-yield bonds may operate in sectors prone to economic cycles, and their financial performance can be more sensitive to changes in economic conditions. During periods of economic downturns or market turbulence, the credit risk associated with high-yield bonds may escalate, amplifying the potential for defaults. For example, consider a high-yield bond issued by a company in the energy sector. If oil prices experience a sharp decline, companies in this sector may face financial challenges, increasing the likelihood of defaults on their high-yield debt. Investors holding such bonds may find themselves exposed to the ripple effects of sector-specific risks that can impact the performance of their portfolios. Covenant quality and structural risks. high-yield bonds often come with less stringent covenants compared to investment-grade bonds. Covenants are protective measures that bondholders rely on to mitigate risks and influence the issuer's behavior. In the realm of high-yield bonds, weaker or absent covenants may expose investors to heightened structural risks. An illustrative example is a high-yield bond issued with lax restrictions on the issuing company's ability to take on additional debt. In the absence of robust covenants, the company may increase its leverage, jeopardizing the interests of existing bondholders. Investors must carefully scrutinize the covenant quality of high-yield bonds to assess the level of protection afforded to them in different scenarios. Diversification dilemmas. While high-yield bonds can provide diversification benefits to an investment portfolio, excessive exposure to this asset class can lead to concentration risk. Investing heavily in high-yield bonds without a diversified approach across asset classes and sectors may expose investors to the fortunes of a particular industry or economic segment. For instance, if an investor allocates a significant portion of their portfolio to high-yield bonds in the energy sector, and the energy market experiences a downturn, the overall portfolio performance may suffer. Balancing the allure of high yields with the imperative of diversification becomes crucial to managing risk effectively in the realm of high-yield bond investments. Conclusion. In the pursuit of enhanced returns, investors delving into the world of high-yield or junk bonds must navigate a complex landscape fraught with risks. From the ever-present credit risk stemming from lower-rated issuers to the challenges posed by interest rate sensitivity, liquidity constraints, and market volatility, a comprehensive understanding of these risks is imperative. Crafting a well-balanced and diversified portfolio that acknowledges the potential rewards of high-yield bonds while prudently managing their associated risks is key to unlocking the true potential of this asset class. As investors tread the high-wire act of high-yield bond investing, a judicious approach, meticulous research, and a keen eye for risk management will empower them to traverse this terrain with confidence and resilience.